Assalamu alaikum. In today's video, we are going to know what a cash flow statement is and how it can be prepared with an example. This video is going to be in two parts. In the first video, we are going to learn what a cash flow statement is and why is it one of the most important financial statements. Previously, we learned that there are three main financial statements in a company's annual report. The first one is the balance sheet, then the income statement, and lastly, the statement of cash flow or cash flow statement. A cash flow statement is a financial report that reports the cash generated and spent during a specific period of time, for example, a month, quarter, or a year. The statement of cash flows act as a bridge between the income statement and the balance sheet by showing how money moved in and out of the business. While a balance sheet shows the worth of any asset, liability, or equity, an income statement shows the sales generated and expenses incurred, but both of the statement doesn't give information about the cash on hand of a business and expenditures incurred and paid by cash, as cash is the blood of any business that runs through the business on a day-to-day activity. The statement of cash flows tells us how cash can be spent on any asset, how much cash has been generated by sales, or how much cash has been raised by a liability, or how much cash has been invested by the owners, and what expenses were incurred and paid by cash. Cash flow statement is divided into three components. The main components of cash flow are operating activities, investing activities, and financing activities. First, we will discuss the operating cash flow. Operating activities are the principal revenue producing activities of the entity. Cash flow from operations typically include the cash flows associated with sales, purchases, and expenses. The example of operating cash flows are depreciation, amortization, expenses incurred, changes in net working capital. Net working capital is basically current assets and current liabilities, interest, taxes. These are all the operating cash flows. Now we move on to the investing cash flows. Investing cash flow from investing activities include the acquisition and disposal of non-current or fixed assets and other investments included in cash equivalents. Investing cash flows typically include the cash flow associated with buying or selling property, plant and equipment, or commonly known as non-current assets and other financial assets that are used more than a year. Cash spent on property, plant and equipment is also called capital expenditures. Cash flow from financing activities or financing cash flow. Cash flow from financing activities are the activities that result in changes in the size and composition of the equity capital or borrowings of the entity. Financing cash flows typically include cash flows associated with borrowing and repaying bank loans. It is basically associated with owner's equity and liability, the right hand side of a balance sheet. The payment of a dividend is also treated as a financing cash flow. In the next video, we are going to see how we will prepare a cash flow statement and how different types of activities goes into the three components of cash flows.